For realtors and investors, planning ahead is one of those things that separates winners from losers. Online searches for what causes housing market value to crash keeps growing. Millions are wondering if there will be a housing market crash in 2023, seeking advice on what to do when the housing market crashes. While odds are that we may witness a housing market crash in 2023, when is the next house market crash? Will home prices drop in 2024? This is a sort of fear-setting or worst-case scenario approach to real estate market predictions. What 2020 clearly showed us is that it's usually hard to predict the ebbs and flows of real estate. No one could have thought there would be an influx of millennial first-time home buyers pouncing on home valuations while the coronavirus vaccine was still in view. Real estate activity in 2020 had a significant effect on the United States economy's rebound. So, I asked some real estate experts the question: if the housing market crashes in 2023, how would you keep your business afloat? Here are the responses I received. I want to be clear that I don't believe there will be a housing market crash in 2023, but if the home market were to change, I would do exactly what I've done my entire career, and that's focus on relationships. As a realtor who receives the majority of his business from past clients, friends, and single family, I would continue to nurture those relationships and be a source of information to help guide them through the tough times ahead. At the same time, I have experience in selling foreclosures in the last housing crisis debacle and would work on redeveloping those relationships to take advantage of any new opportunities that could arise. I don't believe you need to change your business model entirely if you've been focused on the right things the whole time, so I would just continue to focus on those people that know me, like me, and trust me, and things will be just fine. There are 4 main opportunities for investors right now in the housing industry market. 1. Cost to build versus cost to buy. Let me give you an example. Right now we are in the process of buying a property in Katy, Texas. We're buying 2 apartment complexes of 648 units in Katy and paying $73 million for both projects. That's under $130,000 per unit, which equates to $120 to $130 per foot. So, I'm buying a property at well below the cost to build. If I was to build another property values right next door to that property, it would be well over $200 per foot. In Phoenix, that same exact property prices we bought in Katy, Texas will cost a little over $200,000 a unit. And of course, we went record low to Katy because the rents are not that much different because the property is right across the street from the Texas Medical Center. In other words, give more weight to locations where buying estate is comparatively cheaper than building costs. Employ considerable due diligence. Point 2. Housing supply versus housing demand. Take a look at the home supply and demand. Where are people going? What's the occupancy? If occupancy is really high in an area or about ready to be record high because the area is growing, then that means that your rental housing supply and demand is going to be there, and rents will grow like we just saw for the last 10 years in Austin, Texas. 3. Follow the people. People vote with their pocketbooks and their feet, the rider trucks, the U-Hauls, etc. Florida, Texas, and Arizona are good real estate markets right now. But it's very hard to buy properties in many places because people are moving there right now. And you're going to see rental interest rates go up in these places because people are buying properties for investment properties and renting them for the long term. 4. Cash flow versus capital gain. Don't buy properties for capital gains. This is not the time, for example, to buy a home for $300,000 and flip it for $400,000. You want to make it cash flow. You want to use the strong rental interest rates so that whatever you buy will put cash in your pocket over the long term and you're building a primarily tax-free passive income.